Hello, 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 hello.
Recording in progress.
Good evening, everyone. So today's class we will talk about the vertical spread. And since there is still time, let's wait for the others to get in before we start. Let me check if everything is alright, yeah? Let me see. The screen is okay, and then how about the sound? I believe the sound do showing right also. Good evening, and yeah, I think the market has something big coming through though. While Trump is going to get on board. If I'm not mistaken, it's on 20 January, should be. Let's see if Tesla able to make another high or not. Since Elon Musk do have Trump on everything, giving a very great support in the elections. So maybe Trump will just do the same favor and giving a helping hand back. And if you're also wondering what about the policies and what is the sector and industry that Trump is going to affect, maybe you can just join for our next week class and we will talk on that. I'm actually scheduling a class to talk about the Trump policy and the sectors and also the industry that it's going to affect, and we will also cover some of the share that we are going to pay attention to. Just like actually there's just three major sectors that is going to affect. The first one is energy, and then there will be infrastructures, and also there will be the defense stock. And just like energy, maybe you can just pay attention to ExxonMobil, Chevron, or maybe some other smaller company, and maybe they can just take a leap and in this time instead of the last term. And during last terms, I believe that S&P had climbed about 67% in Trump's first term, which is pretty well again. And in next week, we will just cover about Trump policies, and also we will cover some of the ETF selections. People are wondering about how to pick an ETF, how to invest into ETF, and believe me, actually ETF do return you well in the long term. Even though it can't just give you some bombastic returns like Tesla and all those, but the good thing is it will be more stable when comparing to all those rocket sky stock. So yeah, at least you can sleep well. And comparing to just putting all your money into the bank, maybe you can just buy the ETF bit by bit, level by level, and then eventually you will just grow together with the market, and instead of just getting your currency depreciated over time. And let's see, the time now is about 7:03. Maybe 2 more minutes, then we will start on today's section. And today's section, actually you can just utilize on what you learned from today, and then you can just utilize on your daily practice. Because if you are a pro member of uSMART, you can actually see that we do post our daily strategy about options in the group or in the apps, and you can just access to it, and then actually it will just look something similar like this one. on the left hand side there will be a Chinese version, and on the right hand side there will be an English version. And then most of the time you are doing it in a vertical spread manner. So by listening to today's class, by learning on today's class, you are able to just get to know how to construct of these things in real life. So instead of you just checking on this thing and then you are not aware of where to start, and then maybe you can just get to know why are we doing this and understand the basic theory of it, and then you can just utilize of the daily strategy, and then you can just start to make some money. Since we provide everything right from A to Z, the basic theory, the practical manners to do it, and also we provide the daily strategy in the apps. If you are a pro member, or if you do join for our communities, then actually we also post it there. And in the section later, we will also cover on how do we interpret all those, and then how do we just make use of this strategy instead. And maybe you can just do some adjustment according to your own understanding. And before we start, maybe you can just prepare a note for yourself, and then maybe grab a drink or whatsoever. And yeah, if you want to go to the toilet, feel free to do so, and we will start the sessions later on. And if you have anything want to just talk about, want to discuss on, you can just share on the chart, and then maybe you can take a look at the chart and on the share also. Previously there's somebody asking about my opinion on Tesla, and yeah, I can see that he's actually trapping at a very high level, so he couldn't sleep well, eat well, and just keep worried about his portions on that. His portfolio is heavily betting on Tesla, and yeah, I do give my own opinion on that. And about Tesla, okay, this is not a trade call, this is not a buy call, sell call, and whatsoever. This is just for educational purposes, and then we are just sharing for our own opinion in the market. For Tesla, actually, I think that you can just abandon about the fundamental analysis. You can just ignore about the financial report, because this is way past the financial report. The financial report, all the numbers in there are not able to just support on how this share price flying like a rocket. It doesn't make sense at all. The earning per share is like crazy high numbers, and the PE is also ridiculous levels. And how about the technical analysis part? Technical analysis part, I think that on that you can just trade it like a reference, because Tesla, this thing is purely driven by emotional, purely driven by market emotions, and it's more like the product of the market momentum. So in this moment, technical analysis maybe doesn't do well in this kind of share. So I think that there's only two factors that will affect on Tesla pricing. The first one will be, I think, to be either Trump will just giving a helping hand back to Elon or not. So if Trump is going to help on Elon and maybe make some policy that can help on all the segments, then yeah, then Tesla, I believe that there's still room for it to grow. So this is all depends on what happens after Trump is on board on 20 January. And then also we will the second factors will be, this thing is actually pure Tesla is actually having a heavily bet on the technology risk. What do I mean by technology risk is it just generate a lot of technology ideas and the concept, but all of those doesn't really just apply into the real world situation. Like robotaxi, we haven't seen one yet, right? So this is still in progress. This is still a concept. So in order to make this kind of concept reflected back on the share, there must be something come out of Tesla. There must be a product, a solid product come out of this kind of concept. So, but in now the share price already priced in beforehand. So it depends on the quality of the product. If the product is not able to come out at the end, then the share price will drop. If the quality of the product doesn't play well at the end, price also will drop because the market is actually having a very high expectations on what they can come up with. So yeah, this is the two main factors. The first one is the Trump policies, and the second will be the technology risk. And what if the other company do in advance? Like do it in advance, they can just make this kind of robot taxi concept into real world situations, and then they will have a whole dominance on the market. Because technology, this kind of thing, actually the one who are able to just produce first, are able to just make it first, actually will have a very high dominance in the market portion. So yeah, this is a race in between inside of this whole industry. Okay, it seems like the time is around there. So yeah, just beforehand, this is my personal contact. You can just contact me if you want to. And then on the left, there's a Telegram contact, and at the right, there will be a WeCom, or you can add me through WeChat also. So this is two auto contact of mine, and then you can add me if you have any questions you want to ask about how about your positions, your portfolio in the financial market and the other financial knowledge. You can also just approach me anything you want to. So yeah. And before we get started, I will just give a little bit introduction. So I'm Bujun Lo, and I come from Malaysia, and I'm now a senior financial trainer and analyst for uSMART. And yeah, uSMART is actually one of the very great companies that can help you to trade in the US market shares, and also forex, and also commodities, and also cryptocurrency. Yeah, cryptocurrency is amazing right now. Yeah, and yeah, so let's start on today's sections where we will cover on the vertical spread. So when we talk about vertical spread, there might be a little bit of a very boring explanation throughout in the internet. So, and I will give my own explanation on it, and I hope that you can just understand it in a very easy and in a very simple manner. Okay. So this is the topic for today. This is a beginner class, and I will help you to master this kind of strategy, and then you can just make use of the members benefit, which is the pro member are able to get the daily options strategy suggested, just like the one that I said just now, which is something look like this. We will suggest you to buy on what is the strike price, and what is the price that you need to pay, and then what is the price, what is the premium that you receive at the end, what is the maximum profit, the maximum losses, and even the break-even point. So you will receive this kind of thing every day, and then you can just make use of this strategy to make money. And most of the strategy are maybe in the vertical spread manner, because vertical spread is actually a very good strategy for beginners, because it helps beginners to just use their fund in a more effective way instead. Because option itself actually is not that cheap as you think, and if you want to buy those like those top company options, it will be very pricey. So you can just make use of the vertical spread, and then you are able to take a part of it, and then you can just ride out the trend. Okay. And yeah, this is the disclaimer that I will show in advance. And yeah, this is all for educational purposes, and then we are not going to collect any information from you. We are not going to upsell you any classes, and we are not going to give you any trade calls, the buy call or sell call whatsoever. Okay, so this is all for educational purposes, and later on we will jump into the chart section. And yeah, that is also not a trade call, and we are just doing it for the educational purposes by analyzing the chart. Okay. And this will be on today's section. We are in the opening right now, and then now we are jumping into the theory explanation. And then after that, if you have any question, you can feel free to ask. So then we will jump into the chart, and then we will jump into those, maybe in today's example, and then we will just check on how do you just place a trade according to today's suggestions. Okay, so what is option? And in this class, we will not talk about what is option because we already covered it in previous 2 weeks, I guess. In the first week, we already covered about the call options, and in the second week, we already covered about put options. So we already talked a lot on what is options and everything, but we also have. I will also make sure that you will be able to understand later on. Yeah, we will just straight jumping into the example instead. And if you want to just know about the basic theory of options, maybe you can just join the first class in the first week of every month. In every month, we will just do the basic class in a repeat cycle, and for every first week of every month, we will be talking about the options, simply options, either call options, put options, the basic theory, and why you are using options instead of the share and instead of the future. Okay, so if you want to know more about the basics, do join for the first week every month. And I believe that will be after Chinese New Year, I guess. Let's see about what is the next class will be. Oh, too sad I couldn't show the calendar here. Never mind. Okay, so what is a vertical spread? So I will say that this is actually a skill to make your account run effectively. I believe that trading and investment is not just purely a way to just, it's not about you profit or not. So it's about you are being profit and efficient. So that is the key, because you want to just make use of your limited funds to get maximum return instead. And you don't want to just get a large portion of your capital getting locked on some specific stock. So vertical spread is actually a skill are able to free your money from a certain stock and then can just apply it on elsewhere. So you will just avoid the opportunity cost at all. So you have more chance to access to multiple choices together at the same time, and meanwhile you can just make sure that all of your money are in a very effective manner. Yeah. Why are we doing a vertical spread? First thing first, this is actually having a fixed risk. This is actually the most important thing, because once you make the vertical spread, you are able to just limit your risk to some certain amount, and you will know that amount beforehand. So you can just sleep well. You can just put the amount that you are able to risk into it, instead of just keep worrying about your whole portfolio will go up, you go burn, you know. And the second thing is you only require a lower capital comparing to just a traditional buy stock when you're buying stock in the traditional manner, and if you consume you a lot of capital. And if you are doing a single leg call options and put options, it will also take a huge portion of your capital, and vertical spread will help you to reduce that. So it requires a lower capital when compared to a single leg options trading. And the third one, this is very elastic. Why am I saying so? Because when you are doing a single leg option, the things that you can do is very limited actually. But when you are doing a vertical spread, that will become a multiple leg strategy. So in that case, you are able to just make your decisions according to what happens to the market after you make your bet. Okay, and if you just keep staying with us, and in the practical class later on, maybe half an hour later, then we will just go into the practical class, and we will talk about how we just play with this along. Okay, and then the last thing is a higher winning rate. Why am I saying so? Is because I already said that this is actually a strategy to free your capital from locking into some specific stock. So when you have more capital getting free, you are able to make use of those capital to getting back into the other options when you see the other opportunity. So in that way, you can actually having access to multiple options together, and that will effectively increase your win rate instead. And this is how we construct a strategy for vertical spread. First thing first, we will buy one call, and in this class we are just using the call, the bull vertical spread, and you can just do it in the reverse way by using a put option. And if you are not sure about how to just inverse that and then making a bear vertical spread, because in this case we are just talking about bull vertical spread. If you are not sure about the details of the bear vertical spread, you can just contact me. I'll just leave my contact at the end. And then if you are not sure about the process of how to placing the trade, you can just ask me. Okay? The first one, you will buy one call, and then you will have a lower strike price. And the second, you will sell one call, and there will be a higher strike for that. And two of these calls must sharing the same expiration date. Now let's get into it. First step, when you buy one call, when you buy a call, that means that, let's say in this case, I'm buying a call with a strike price of 100. So in that case, I'm actually betting that during this expiration period, the share price are able to stay above 100, stay above my strike price. I'm actually betting it to fall above this area, and in that way, I will be in profit. So what am I doing is actually, I'm doing a trend trading. I need to identify the trend, either it will go up or down, then I will place the options bet. Okay? So for a call option, I'm actually betting the price to go up during before the expiration. Okay? So in there will be expiration in this case like this length. So this is actually a game of the time and space. The time is the expiration, and the space is either it will go up or down. So if I buy a call, I'm betting it to go above 100 before expiration. If I'm buying a put, it means that I'm betting it to go below 100 before the expiration. So in this case, we are buying a one call, right? So I'm actually betting it to fall into this green zone. In that case, when I'm buying things, I need to pay money, and the money that I need to pay is this $5 premium. And when you're buying one option, you are equivalent to buying 100 shares. That means that you are not only paying $5, you are paying $5 per share. In that case, one option is equivalent to 100 shares. You need to pay 500. So actually, the option is not a poor man game. That's why I'm talking about when I want to buy this one, I need to have $500 on hand before I can just place the trade. So if vertical spread is actually coming to solve this question. If I don't have $500, then I can use vertical spread to reduce that. How? I'm selling one call. When I'm selling one call in this example, having a strike of 105, which means that when I'm selling things, I'm getting some premium, and this premium is $3 per share. In that case, I'm getting back a $300 when I'm doing the selling call. So in this case, previously I paid $500 for buying one call with a strike of 100, and then now I'm getting back $300, which means that the net amount that I'm paying is only $200. Now you can see the effect, right? So and this is how vertical spread is formed. I buy one call, I'm betting directions to go up in the future, but I don't have that much money on hand. That's why I'm selling back one call to get back some premium. So in this case, I'm paying $500 upfront, then I'm selling one call back I'm getting 300 back. So, but the downside is whenever the price go above 105, my second position will go into losses. So this only and that losses will offset with my first position. In that case, you can see that my profit is now limited to only this area, the green zone, and whatever that is above 105, the losses for the profit from the first position will offset with the losses of the second position. Can you understand that? The profit from the first position will offset with the losses in second position. In that case, my profit is only limited to 105. Will be kept on 105. Whenever that the price go above 100, I start to make money, and my maximum profit will be arrived when the price hit 105, because whatever that above 105, my profit and my losses will be offsetting each other, and I didn't make anything. So the downside of it is, even though I have a cheaper premium to pay, because previously we already said that, right? You pay 500 upfront, get back 300, and then the net that we pay is only 200. I only pay 200 to just ride on the trend, but it will limit my profit with a cap of 105. Okay? So now we come to the calculations in theory. Why I'm saying that this is in theory, but because in the real world, this is actually not how it plays. Okay, but we also cover that later on, yeah. So I'm not sure whether you can just keep catching on or not, but make sure that you maybe just do your own notes. And yeah, for now the recording is still there, but I'm not sure about future, so we don't bet on the uncertainty. Okay, but if you do miss on today's lesson, we will do it in a repeat cycle, so you can just join for the third week of every month. Okay, so now the maximum profit that I'm able to get is actually calculated by using this graph. So my maximum profit is actually 105 minus 100, so there will be actually a $5 profit. And do you remember that we buying one option is equivalent to 100 shares? So a $5 profit per share, which means that we will be having a maximum profit of 500, and then once we deduct that with the premium that we pay upfront, which is $2 per share, and that will be $200, and the net profit that we are able to get will be $300 when the price goes above 105. As simple as that. Because 105, from 100 you start to profit, and when it reach 105, the profit is $5 per share. As simple as that. Because one share, whenever the price go up for $1, you get profit $1, right? So that will be $5 per share, and then for 100 shares, there will be 500 maximum profit, and then after you deduct with the premium that you pay upfront, which is 200 for this strategy, then the maximum net profit you are able to get is 300. Now this is how you calculate that. So if you want to take a picture of that, it's also okay. So yeah. Repeat once again the risk to reward ratio profile. Maximum profit is the spread, which is 105 minus 100, which is $5 per share, minus the strategy premium, which is previously we pay $5 per share, and then we get back $3 per share, and then the net that we pay is only $2 per share. If you are not able to catch up, do let me know, yeah. So this $3 per share is my maximum profit for this strategy, and the maximum losses will be the premium that we pay upfront for this strategy, which is $2 per share. And the break-even point is very simple because you want to cover back what you pay upfront first before you can start to make profit. So that is $2 per share. So you want to make it back, you need to go up for $2. So the break-even point will be 102. As simple as that. If all of you are able to catch up, then we shall just continue. Okay? So all of those are actually just a P&L after exercise. A P&L in theory. But what if in real-time situations, real-world situations? Because actually people come to options, we don't exercise the options. We just trade the options to gain the fluctuations in between the premium pricing. And if you're not sure about what we are talking about, then do join for the first basic class in every first week of the month. Okay? Exercise options, most of us won't. Why? First, we already say that one option is equal to 100 shares. When you want to exercise that, you need to make sure that you have the money, you have the capital to buy 100 shares. You know? So when we come to options, we want to use a very small amount of money to bet on a very high return. And with that criteria, this is very contradictory to the theory of exercise, because when you want to exercise, you want to make sure that we have the money to buy 100 shares. So in the previous example, we are using a strike price of 100, right? So we are required, when we want to exercise, we are required the capital to buy 100 shares at that strike price, which is 100. That will make it 10,000. If I have 10,000, will I trade options? Maybe, probably, but most people doesn't have 10,000 on hand when they are trading options. So this is contradict to the core principle of trading options. So normally we don't exercise the options. We just buy the options and sell it back to the market before the expiration. Okay? Second, this is very complicated because it involves the share deliver. When you want to exercise, you just deliver the money to the platform, and then platform you just deliver back the 100 shares to you, and then it will take time for all those process, a very tedious process, and then it will make the whole process become very complicated. So most people just trade the options, get in and get out, and then they won't exercise that, so that won't be involving the delivery of the share. Okay? You won't get a sign of any share. You will just buying the options and selling back to the market, just like a normal buy low, sell high in the market. Okay? Just trade the options like one of the asset that you have traded for the previous time. So this is what we do. We trade the options, which we gain from the difference in the premium, because when the share price rise, the option pricing will also get rise. So we want to just benefit from the rise in premium. So let's check on the real scenario of bull call spread. And this is the example that I had captured previously. So with this, the first one is the GLD. GLD is this asset, which is a gold ETF. And then the second term here is actually the expiration date. So this blue vertical line is actually the time until expiration. And then the 244 is actually the strike price. So what do we mean by this? The last term is call option. So this is actually that we want the gold ETF to just go into this green area, then we will be in profit. As simple as that. Okay, so call option, if we are betting the price to go up, and then the time already decided by the expiration date, and the level is already decided by the strike price, which is 244. So whenever in the future that the price fall in this green zone, we are high likely to be in profit. Okay? Why we are saying that we are high likely? Because there is actually something else like time decays and the volatility squeeze and all those. But in this case, we won't cover all those complicated knowledge. If you want to know more, text me. Okay? I will just tell you everything I know. Okay? So when we are buying one call, you can just open your app and then you can just check for the premium. So in this case, you need to make sure that this is options and then the underlying asset is correct, and then you can just look for the same expiration that you want to trade for, and the strike price is 244. Now you can see that the call options here, the premium is falling on $4.41. So, which means that when the first step is buying one call, which means that you have to pay $4.41 per share. That will make it $442 to just benefit from the upward momentum when falling into this green zone. So if you don't have 442, that is how vertical spread will come into play. The second step, you are selling one call, and that is actually the maximum profit, the cap of your profit. So do adjust it according to your needs. So if you just want to having a higher profit, then maybe you can just place it at this resistance, the recent resistance. And since this is just for illustration purposes, I was just randomly picking a $3 up. Okay, so in this case, we are selling one call. When we are selling things, we are getting the premium. We are receiving the money. So for the strike price of 247, the premium is falling on $3.14, which means we will be collecting back $314. Okay. So when we are combining this kind of spread, these two positions, that will form a vertical spread, which means we initially want to pay for 442, but now we are collecting back 314. That means we are only paying it maybe 128. Okay. So when comparing to 442, you are only paying 128 to just bet on the direction. And that is why vertical spread is a beginner-friendly strategy when comparing to the other. So what happens if the real situation that price go up? How do we calculate that? That the share is up for 2.46%, and how much will the premium go up? Let me show you. This is actually a premium, and this premium is actually will just fluctuated along, just like a normal share price will do. So this is actually when the share price go above, this will also go above, and the relation is binding by what we call effective gearing, and that is actually the leverage on this option. So you can check that the effective gearing for both of our positions, the first position and the second position, is falling on 26.6 or 27.65x, and also the other one is 31.990x. Even though I say that there will be a leverage of 100x, because one option is actually equivalent to 100 shares, but the other factors come into play, like the time decay, the cost that you pay, the premium, so it eventually raise your break-even levels, and all those come into play to make your leverage effect not as much as you think like 100x. You make it something like this, which is what you see on the screen. Okay, so this is actually the effective gearing that you can just using it to measure that how much the premium will go up in the future. So let's say when the share go from 244 to 250, go up for $2.46, 46% in percentage. Okay, so this is two of your positions. The first position is a buyer position, and the second is a seller position. So we just go through it one by one. Yeah. So for the first position, it's a buyer position, right? When you are a buyer, which means that you buy things first, so you need to pay first, and then after that you're selling that thing back to the market. So initially you buy first, so you pay first, and the thing that you need to pay is a premium upfront, which is $4.41 per share. And when you use the effective gearing, then you can just having a rough idea of how much this premium will go up in the future. So you already buy this call option, right? And then when the share price go up for 2.46%, and then you multiply this 2.46% with that effective gearing, you can have the estimated gain in this premium. So the estimated gain in this premium is 67.99%, and then that is how much this premium will go up in the future when the share go from 244 to 250. Okay, so the premium will go from $4.41 to $7.40. And if you do remember that this is a buyer position, we buy one call, right? So we pay up front, and then we get the options, and then after that we're selling the options back to the market. So initially when we buy, we pay 4.41. After that we're selling back, and then we just selling it for 7.40. That is how a buy low sell high take into play. Okay, and the second position is a seller position, and then initially we are using it to just minimize the premium that we need to pay. So the initial premium that we gain is 3.14, and then with that effective gearing, and you can know that how much this premium will go up in the future. So if you just rise from $3.14 to $5.60, and you can see that even though this second position is a losing position. Why am I say so? Because previously when you sell, you are getting $3.14, but later on when you buy it back, you need to pay $5.60. So which means that you are actually selling low, buying high. That's what make you lose in for the second position. But this is how a vertical spread works, because the gain will always able to cover the losses. And you can see that the net losses the net cost that you need to pay up front is $1.27, and then after that when you are closing this whole position, you are able to get back $1.80. Now you can see how this play, right? So the gain from the buyer position is always way more than the losses that you will be that you will have on the second position. So initially you sell the cost that you need to pay to buy on this strategy is $127, and then after that when you're closing your position for this strategy, you are getting back $180. What if the share doesn't just stop at 250? It keeps on going up and up, like 5%, 10%. What will happen? You can just pay attention on the final outcome. So let's say that it go up for 5%, and the money that you are able to make is way more when comparing to the first scenario. What if it go up in 10%? Now you can see how this profit you're getting more and more. But you need to pay attention to is, if you exercise your right, is that a direct cash settlement? or it will involve an actual stock delivery, because when you're buying a call, you're actually able to exercise your right and buy 100 shares at your strike price. So when you exercise your buyer position, you will need to pay the money to the platform, to the seller, and then you're able to get 100 shares back. After that, you only use that 100 shares to cover your seller position. And is that only that is what we call an actual stock delivery. But most of the platform only do a direct P&L settlement. So make sure that you need to just consult to your platform before you make this kind of strategy. And it will be different way to do it in these two scenarios, because the first one is the most simple. You don't need that much of money in your account for your exercise. You can just close your position and get back your profit. And the second one, you need to have money enough to just exercise to buy 100 shares. Okay? So make sure you consult your platform, your customer service before you play this kind of vertical spread. Now is where the practical part gets in. Do any of you need to have some rest time? If you don't, maybe we will just get started directly. Let me check if any of you have any questions here. It seems like there's no questions. And yes, there's no questions from two of the platforms. Yes, then let's start on the practical part. Okay, so I guess we will just tweak a little bit of how we do the practical part. Maybe we'll just go into today's cases where we give suggestions on the SLB share. The front will be the what is the reason that back me from doing this kind of thing, and the second is how do we just make this into use. Okay, so when it comes to vertical spread trading, first thing first is you need to pick a suitable stock, because when you get back to it, this is actually you are still betting on the direction, and this is actually a cheaper way of trading the trend. So the main focus is to trade the trend. So you make sure that you pick up the right stock that will go into your flavor, go into your direction beforehand. So the first thing first is you pick the right stock, and then you have your direction bias on that. And normally, people will have different way of how they are picking up their stock. Maybe let's say like Tesla, this is obviously in the uptrend. So maybe if you do a vertical spread here, this is how you can do. Multiple levels here. So you can just buy one call here with the strike price of 428, and then afterwards you can just sell one call with a strike price of 465 or even higher. So you need to make sure that you will have your seller positions at the resistance, and then you will have your buyer positions at whatever you want, because it will just affect the area that you make profit. So let's say that you have your buyer position here. This will be your profit zone. And if you have your seller position at a higher level, then you make your profit level increase. So what if you adjust this one? You can also do it that way. Like you want to increase your win rate, maybe you can just do it this way instead. But do remember that the lower strike that you buy, you need to pay more. So normally we'll do it with the reasons level. the recent pricing level. Okay. So this is how you do it. First of all, you pick a stock and then you decide on where is the level that you want to buy or what is the level that you want to exit. And normally when we are doing this, we are making sure that we buy at the most recent level for the buyer position, because if you make it cheaper and the seller position will be deciding on how greedy you are. If you want to make profit more, then just placing it as high as you can be. Okay, so this is how we do it. We identify the share, we pick the share, we identify the direction, and then we buy in our buyer position. Then we decide on what is the level that we want to have our maximum profit. So let's see on today's cases. Let's see SLV. Okay, SLV. So when I'm actually analyzing SLV, I will say that actually this one actually go down for quite some time, and eventually you are able to just picking up when the share is retraced. So if I want to do this, I have my own bias, like you break down the low and then you come back. So whenever I want to buy it, I will just placing my buyer position at the recent level, and then this is actually the most recent resistance zone. So but you can see that the most recent resistance zone might be falling around 44, 43 and 40, 44. So let's see that do we have the options with the strike price of 44 or not. Okay, so when you open up the uSMART app, first thing first, to look for SLV. And then at the bottom there, you can see that there is an options tab, and then you click the options, you click the more, and now you can see that this is all the options available. And make sure that you're picking up the share that is having a higher market cap, because in that way you will have more options available for you to choose. So this is very important, because the more options that you are able to choose, which means that there is a very high liquidity provided. Which means when you are buying the options, you can get in and get out without any further problems. Okay, the camera get blurred a bit. Let me just wipe it off. Okay, so you want to make sure that the share that you buy have a higher market cap and higher liquidity. In that case, you won't face a situation where you are not able to get into your position or get out of your position after your trade. Make sure that liquidity is very important. Okay, so let's see that when we are picking the options, normally we want to choose for the option that is going to expire in 1 month or 2 months. The basic theory is very lengthened, so if you want to know more, you can just ask me after the class. Okay, so picking up the expiration of 1 month to 2 months is very appropriate if you want to have short-term trading, because it provides enough room for you to breathe, and the option won't be that expensive. Okay, you can also check that if I'm picking up for those that is going to expire in 2025 September, you can see that even though the same share price of 40, this one is actually selling on $1.68. Meanwhile, this one is actually selling at $4.50. So by picking up the options with the expiration date between 1 to 2 months, it will make you achieve a balance in between the room to breathe and also the pricing. So let's say that in this case, we are picking up this one that is going to expire on February 14th. Okay, now let's draw a line for that. February 14th. Here I go. And this when I'm doing this, I'm actually betting on the directions that it will go up in the future before the expiration and it will fall into this zone. If you want to have a higher profit, you can also targeting on the other area, okay? But I only target on the most recent resistance, okay? In this example. So when you are doing this, I will make sure that I have my buyer positions around the current price. The current price is falling on 40.64. That is why I'm going to buy with the strike price of 40.64. I'm going to buy on 40. And before you just jump into it, make sure that there's two things you can check. First is the volume. You need to ensure that the options that you trade have high enough volume. The suggestion that I provided is having a expiration date of February 21. Why am I doing so? Because these two actually falling on 1 to 2 months. And you can see the difference in between is actually the volume. You can see that this one, the volume is actually way smaller when you compare it to this one. So if you want to make sure that I can get in and get up without any problem, then this is actually a better choice for me. And if the pricing doesn't go too far above, then I will just picking up the one with higher volume. This one you need to pay 183. This one only 187. There's only $4 difference. Then why not you are picking up the one with a higher volume instead? So this one, when I'm buying this, I'm actually paying $1.87 for this buyer position. And make sure that you check the volume, there's high enough volume for you to trade, and then you can just get in and get out without any problem. But if you do remember, we do need to sell it off after it go up. So want to make sure that the option that you trade has higher volume instead. Okay? So when we're doing this, we pay 187. Oh no, yeah, 187. I'm using the price, the latest traded price, and you can see it's 187. So the premium is 187. And then when I'm going to decide on my seller position, I will just check on the chart. You can see that the reason, the most nearest resistance is 45. So I'm actually picking up the options with a strike price of 45. This one. And having the premium of 30 cents per share. So this is how we construct this thing. First one, I buy the most recent one for me to get into my position without any problem at the reasonable price. Second, I decided on the level that I need to take my profit, achieve my maximum profit. In this case, it is 45 because it doesn't have a 44 one. It only has 42.5 and 45. Then I pick the 45 one. Okay. In that case, I will receive a premium of 30 cents per share. So this is when you're making the calculation. When you are receiving the premium of 30 cents per share, and if you do remember that one option is equivalent to 100 shares, so 30 cents, you will need to multiply by 100 shares. So you receive $30 for the seller position, and you need to pay for the buyer position, and the buyer position will be equivalent to $187 because the premium is 1.87 and one option is equivalent to 100 shares. And now you can get that this is actually the maximum losses that you are able to have, which is 157. And this is also the premium that you pay up front when you get into this strategy combination. So when you want to calculate the break-even point, this is very easy. You will just divide it to get back on how is the premium divided by 100. So you know that this is the premium that you pay for every share. And when you want to cover back this one, you understand that when you go above 40, you start to profit, and you will achieve a maximum profit at 45. That's why your break-even point will become 40 add on this one. This is the premium that you pay for every share. So when it go above 40, you will start to make profit, but the profits are not able to cover back your premium pay upfront yet. So make sure that you, if you need to go up above 41.57, then you are confirmed that you are able to cover back the premium that you pay upfront. Then later on, you will achieve a maximum profit of 343 at the end. How do we calculate that? So we will just do a simple mathematics. 41.57 is actually your break-even point, because when you go above 40, you will start to be in profit, and then go above 40, you will start to be in profit, and then you need to cover the premium that you pay upfront for every share, which is $1.57. This will become your break-even point. And then at this moment, you start to make money in a real calculation manner. So you will achieve a maximum profit at 45. Just use 45 deduct by 41.57, which is $3.43. That will be your maximum profit per share. That will make it 343. So as simple as that. 343. Now we will just recall it once again. Yeah. First thing first, pick up the right stock to trade. And then after that, you will decide on the level they want to buy and the level they want to sell. And by picking up the one with 1 to 2 month expiration date, oh, this one is wrong, it will be falling on this February 21 instead of just not that one. So you can just picking up the buyer position and the seller position. That will make it a vertical spread combination. And then you need to check for some details like the trading volume, so you can make sure that you are able to get in and get out without any problem. Okay? Oh, I can see that there's one question from there. Do we need to close earlier than the expiration when we see profit, or just let them run until expiry? There's a question from the attendee, and he's asking about, do we need to close earlier than the expiration when we see profit, or just let them run until expiration? My answer to that is always close before the expiration, and always close before it achieves a maximum profit. Why? Because when you are having a seller position, and whenever the price go above that, you will have the risk of getting exercised, and that will make the whole process getting so complicated. So whenever that you are in profit, make sure that you can just close the position and take the money, and then you can just buy another stock, buy another share to invest. Okay? So you want to just make sure that we are doing the trading and investment in the most simple manner. So make sure that when you touch the top roof before the expiration, make sure you close your position. Okay? Let me check if there's any other questions. Okay, it doesn't seem like there's any other questions. And I think that is all for today. Before we get in on that, yeah, I will just show you a little bit of the handphone interface. So when you go to the phone interface, when you click on the trade button here, it's actually showing you 3 buttons. The first one is the buy/sell, which when you want to have a buyer position, you will just click the first button. And when you want to have a seller position, you can just click on the short selling button, which is the second button. Don't make confused of the first sell in the first button, yeah. So even though you want to sell a call, you click the second button because the sell for the first button is equivalent to closing your buyer position. And when we are doing this, you are actually, when you want to buy this one, you can just pick the one that you want to buy, and then you click on the first button to buy. And then when you want to sell the second position, you click the second button to sell instead of clicking the first button to sell. Because when you are clicking the first button to sell, it's actually somehow equivalent to just quit your first position. Okay? Even though the strike price is different, it won't cause that manner, but I'm just explaining why there is 2 buttons and why there's a sell word in the first tab. Okay? So when you have the seller position, click the short selling button, and you want to have the buyer position, click the first buy/sell button. As simple as that. And that is all for today. And this is the quote that I believe very important. Completion is more important than perfection. Make sure that you start first and then you refine it later, because knowledge is always that you are not able to learn everything before you get started. Okay, so make sure that you take your first step, and then hopefully maybe you can just start your trading later when the market starts. So make sure that you start first and then you come to perfection. If you don't take the first step, then you're never able to get any knowledge or any experience from the market. Okay, and this is the way to contact your managers if you have any questions. And you can just go to your app and then you tap mine, and then there will be a tab calling manager, and you can tap the manager, then you can just chat with your manager, and then maybe if you want to get into some group, you can also do it that way. Okay, and then this is my personal contact. On the left there will be a Telegram contact, and at the right there will be a WeCom contact, and you can for the WeCom you can use the WeChat to add so. And that is all for today. And if you guys don't have any questions, then we will be ending for our session right here. And as you can see that there's one question from Steve. Thanks. You're welcome. And yeah. Let me recap again. For next week, we will have a class on Tuesday and also on Thursday. On Tuesday, we will be talking about Trump policy and the sector and industry that is going to be getting affected. And we will also cover on what is the share that we need to pay attention to, and maybe we can take the advantage of Trump getting on board, and then we will make some profit from that. And for the Thursday class, we'll be talking about ETF, the index investment. So if you have many money and then you want to just avoid that your currency gets depreciated, then you want to just have a very stable way of doing things, making profit, then that is actually a very easy way to do so. You can just keep on DCA your account. When I say DCA, it's a dollar cost averaging. So it means that you just keep on put a little bit of money into that bit by bit in the long run. Then in that way you'll be able to grow together with the market. grow together with the world, so it won't make your money just sitting in your bank account without doing anything for you. Make your money work for you, and that is actually a very great way to start with a very minimum risk and a stable return. So Tuesday class, Trump. Thursday class, index investment, ECA. Okay, stay tuned, and yeah, just you can end if you want to, and if not, then we will just aim for today's section. Thank you all for joining, and hope to see you guys again on next week.